Hi guys, today we're going to discuss financial statement analysis. And to start the discussion, first of all, what we have to ask to ourselves is why we do need to know financial statement analysis. Now, there are a lot of reasons, but let's just assume that you're here working in a bank, you're working as an analyst, and the bank basically asks you on a daily basis to look at the share price of these company, for example, look at their profitability, look at their liquidity, look at their solvency ratio, and so on and so forth. Forget about those sophisticated terms. What these boss actually want you to do is answer this question: should we buy the shares of the company, or if there's company who asks for loans, should we give them the loans? So this is basically the questions that need to be answered when they're talking about liquidity, solvency, and so on and so forth. How you can do that? There are a lot of ways to do that, but one of them is you look at the financial statements and you make some sort of analysis based on the financial statement. Now, financial statement analysis is basically a small part of business analysis. So, if your company probably wants to invest in one other company, you conduct business analysis. If you're working in the bank and the bank wants to give loan to a certain company, you conduct business analysis. So business analysis itself is divided into several terms with several specific goals. Some people say it's a credit worthiness analysis. When a bank do business analysis towards a company, that's called credit worthiness. Um, when there's a other company who wants to invest in other companies' shares, it called equity valuations. But basically, this what is similar is these two business analysis. Both of them use financial statements as their main source. Why do they choose to use financial statements? Is because financial statements reduce uncertainty and increase confidence in making business decisions. Now we look at the steps in analyzing financial statement. Now we do know that there are a series of analysis we can do in financial analyzing financial statement. The first is business environment analysis. Second is accounting analysis, financial analysis, and the last one is prospective analysis. Let's go through one by one. In business environment analysis, what you're doing is you look at the financial statement, you look at the director's report, you observe the industry characteristic, you look at where, so say you're analyzing a company working in mining industry. So what you want to do is look at the mining industry as a whole. You want to look at Bloomberg, you want to look at the age, you want to look at other media, you want to know the industry characteristic, you want to know what drives the revenue in that industry. And we also want to know how the company, specifically our company that we're going to analyze, how the company deal with this kind of industry. Is there any motive of the management in driving the operational of the company? We can look at the motive basically, and on the remuneration report we can look whether the management actually have some sort of compensation based plan that could be given if the company works well. So basically we want to know the overview of the company. This is step one. Now after we understand the condition of the company, we can go to the step number two, which is accounting analysis. What we basically do in accounting analysis is we make some sort of adjustments. Now we do understand that the company's financial statements is on 31st of December, but probably you use it not on the date. You'll probably use it on April. You probably use it in June or July. Now you have to make some sort of adjustment because things probably have changed. The assets value probably no longer are worth exactly the same as the as stated in the financial statements. So these kind of adjustments that need to be conducted before you go on further. We just did non value added information such as non recurring items, restructuring charges, and so on. And we also look at whether there are some sort of earning managements going on in the company. Now let's look at how we can do this. First, we look at the financing activities. We can analyze even with some sort of adjustment. We look at whether the company conducted an off-balance sheet financing, whether the company miscategorized the leasing that they have. After that, we can analyze and we adjust investing activities. We look at the securities, receivables, derivatives, whether the company already valued them uh, according to the standards. Company investment, whether there are international investment has been made by the company, whether there are some sort of combination, business combination happen in the operation of the company. And the last one is also look at the operational activities, and we want to make some sort of adjustments. We evaluate the accrual principles in their income statements. We want to know whether the incomes generated by the company is strong enough. We also want to evaluate the cash flow probably and the revenue or expense recognitions. Now, after we conduct the accounting analysis and we are sure that we already have the numbers that reflect the economic reality of the company, we can go on to the next step. Now, the third step we're going to do is we want to conduct financial analysis. Now, what we want to do is basically evaluating financial positions and the performance of the company using the financial statement that we have already adjusted using the accounting analysis. Now we want to do the financial analysis by conducting first what we call as cash flow analysis. We do this basically by evaluate the source and the use of the cash. We want to know the policy of the company and make use of the most valuable asset that the company probably has, which is the cash itself. Now, if the company is able to generate positive returns, positive cash flow through its operating activities, it's probably a good sign. Now, we also want to look on the invested capital ratio and the profitability analysis. We can do this by evaluating the return on investments divided by the assets that they have. Now, basically, we have to do this, and but not only stop in here at this point, but we also need to continue by comparing with the standard of the industry. Now, you also want to look at the risk of the company. We want not to be specific. We're looking at the financial risk of the company. We evaluate the riskiness and the credit worthiness of the company by using the financial risk analysis. We basically look at whether the company able to generate cash flow, enough cash flow to cover the interest expense, the payables, the liabilities that occurs in the current period. We'll look at the ratio. We look at the capital structure of the company. Now, the techniques that we can use to conduct financial analysis is we can use the year to year analysis. We can compare the numbers in the financial statements that we have and we compare it with the previous year or put 2 years back, and we will look at the trend, whether it is increase, decrease, or steady, and it's basically reflecting the policy of the companies. And we also want to look at the common size. What we mean by common size is we look at the number in the financial statements, say balance sheets or income statements, and we choose one number that could be the benchmark. Say we want to look at the income statement. We look at how many percent of the revenue that goes into the cost of goods sold, probably how many percent of the revenues that goes into net profit. Now, after you do the financial analysis, we can go one step further, which is conducting the perspective analysis. Now, this is one of the most important part, especially when you want to do the equity valuation. We look at the NPV of one company, and we basically look at the value of its equity or and its debt. Well, there's a lot of ways to evaluate equities, but one of them is you look at the discounted the dividend payment by its required of return, and you could also look at the value of its debt by discounting the interest payment by the effective coupon rate. Now, basically what we are going to do in perspective analysis after we know the value is we actually make some sort of forecasting the stream of the earning in the futures. Now, you by doing prospective analysis you will understand the value of the company, and you could make a better decisions in whether you should give them credits or you want to buy the shares. So basically that's all for the financial statement analysis. Thank you for listening. What we need to bear in mind is that when we're doing financial statement analysis, we have to make sure we don't really step out of the line. So we have to know on what frame that we're going to do this statement analysis, whether we want to give a company a loan or we want to buy shares in the company, because probably the result is the same, but you might want to focus on different elements of the financial statement. And also be aware that some of the explanations here is quite simplifying. It's intended to be simple. So there are a lot of complexities inside of performing the financial statement analysis. It also depends on the industry and depends of the company itself.